Hello, everyone. This is Tony Lawson, CEO and co-founder of SHOPPE Black. Today, I'm joined by Mr. Clive Davis. He's a founding principal of Park Royal Capital, a commercial real estate investment firm that focuses on primarily acquiring and investing in multifamily properties. How are you doing today, Clive?
Doing great. How are you, Tony?
Doing fantastic. Thanks for asking. So thanks for joining us today. I definitely wanted to jump right in and learn more about your background and when you first got involved in real estate investing.
Yeah, so the background is started out professionally as a corporate transactional lawyer, working for a Wall Street firm or Wall Street servicing firm in New York City. And so I did that for several years before transitioning and becoming in-house counsel for Pfizer, who's been in the news for all the right reasons more recently. So I worked for them for approximately 6 years. They actually relocated me to Atlanta to be their Southeast, the lawyer for their Southeast business, which was headquartered in Atlanta. And then I left them and went on to become a chief compliance officer for a Belgian, Brussels-based headquartered pharmaceutical company with US headquarters also in Atlanta. So all in all, I had a 20-year corporate run and concluded that run at the end of 2016 and have been focused on real estate full-time since. And we'll get into kind of the details of what I've been doing during that time. But all throughout that 20-year period, I had always been invested in rental properties, smaller multifamily properties. My very first real estate investment property was a duplex that I acquired back in 1999. So I was living and residing, working and residing in New York City. And I acquired a duplex in Southwest Florida, which is where my parents had retired 3 years earlier in 1996. And that was my first foray into real estate investment. And really, it served as a way for me to subsidize my parents' retirement because I effectively opened up a checking account. I put their names on the account. I had the rent payments going into that account. And so whenever there was a need, I could just direct them to or remind them that you don't need to ask me, just access the account. So that was my first journey into real estate investment. I was blessed to be and was for most of my corporate career well compensated. And so the real estate investments that I was doing on the side were never, it was never a source of income that I was reliant upon. And so, I self-manage that property and others that I would acquire. I held that first property that I mentioned, I held it until 2018. So definitely, by all definitions, was a long-term hold. And it turned out to be an instrumental investment because that helped kind of bridge the gap between walking away from a W-2 at the end of 2016 as I was kind of gearing up to get into the large-scale multifamily space. The cash flow and ultimately the sale proceeds from that property was part of the bridge that helped me kind of hang in there until I had the breakthrough of my first large-scale multifamily. And again, we can get into more details. I'll pause there.
Yeah, no, that sounds really interesting. I definitely, when speaking of multifamily, I wanted to get your thoughts on, like, before getting into your specific, the deals that you've done, what are your thoughts on the current multifamily market? And you're based in Atlanta, so if you could kind of break down Atlanta and then the other places that you're invested in.
Yeah, so regardless of which list that you look at, Atlanta is going to be in the top three, among the top three markets in terms of strength of the multifamily space and sector. And so usually it's jockeying for position between DFW, Phoenix, Tampa, down in Florida, and Atlanta, and they jostle for positions. But this isn't a recent thing. Atlanta has been one of the strongest multifamily markets for more than a decade now, if you look at number of units and transactions taking place on an annual basis. And again, that's not an overnight thing. That's something that's been sustained and present for, like I said, over 10 years. So the market currently, one thing I will tell you is that at the height of COVID, so if you rewind to March, April timeframe of 2020, when we were at the onset of COVID, and there was a lot of uncertainty as to what's going on in the market and how is multifamily going to perform. I can tell you that there were only 3 metropolitan areas in the entire United States that had positive rent growth. And Atlanta was number 1. I think Phoenix was number 2, and I believe Philadelphia was number 3. Every other market had negative rent growth. And again, this is going back to the height of COVID and its onset. And that speaks to the strength of the Atlanta market, that although obviously rent growth pared back substantially, they still were able to eke out rent growth that was, just above being flatlined. Whereas most other metros, with the exception of the 2 that I mentioned, they were all negative and substantially negative. And so again, that speaks to the strength of the Atlanta market. You've probably heard, your audience has probably heard about kind of substantial rent growth year over year that we've seen. I mentioned Tampa. Tampa is probably one of the top 3 rent growth markets. I think they experienced year over year rent growth of about 25%. Atlanta has been not far behind, where we've experienced, depending on which submarket you're talking about, anything from the upper teens to the low 20 percentage points in terms of year over year rent growth. We've also been one of the stronger markets in terms of our recovery and return to full employment, so to speak, coming out of COVID. And one of the few things that is offsetting the year over year rent growth is that we are also seeing wage growth and real wage growth relative to what we're seeing on the rental side. And what I'm hearing anecdotally and otherwise is that a lot of employers are having trouble gaining back, or having employees who were furloughed or let go, they're having trouble getting them back. And so in order to attract them back or attract new employees, they're having to pay more. So what they were paying 2 years ago or a year ago is not getting the job done. And so we are seeing wages rise, not across the board, but selectively, depending on what the sector is. We are seeing some of the service level jobs that are having to pay more. I'm invested in a portfolio of hotels here in Atlanta, so we know that both office and hospitality took a substantial beating as a result of COVID. And so hotel jobs are paying more, they're having to pay more, much like restaurants and some of the other service sectors. So I would say that at a macro level, I feel really good about multifamily as a sector to be invested in, because we have such a supply and demand imbalance between the number of housing units that are needed relative to the number available. And I think I've heard estimates consistently, that there's a shortfall of between 4 and 5 million housing units, less than what we need. And that imbalance or that shortfall only increases on an annual basis. Even if we were to, I don't know if it's probably something like 1.1 to 1.3 million housing units that we need to be building and delivering each year just to keep pace with current demand. So that's, even if we were to do, let's say it's 1.3, don't hold me to the number, but if we were to deliver 1.3 housing units each year, that would only take care of the demand generated from that year. That would do nothing to put a dent in the backlog, which I mentioned being 4 to 5 million. And so because of that supply and demand imbalance, we're in a very different place than we were back in 2006 and 7 and 8 when the Great Recession arrived, where we had, everyone was, buying homes and second homes, and the lending standards were much looser. That led to a bubble that, ultimately burst, as we all know and experienced or observed. And we're just in a very different place. And I think that's something that once you appreciate that, you can put a lot of things relative to housing in a better context relative to that time period.
Sure, no, that makes a lot of sense. I was wondering, in addition to, because you mentioned investing in a portfolio of hotels in Atlanta, are there any other type of commercial property type that you invest in?
So far, it's just been, the bulk of it is multifamily, and the bulk of that is existing stabilized existing units or communities. But I've also invested in ground up development of multifamily. So I'm invested in ground up developments of multifamily in San Francisco, Austin, Texas. And I'm also invested in a office to multifamily conversion in DC. And so that one's kind of an outlier. But it's a development investment that I'm involved in.
That's interesting. And could you speak on your journey from 5 units or that duplex that you bought for your parents to where you are now, and tell me, like, how many units do you have total at this point?
Yeah, so the first thing I did in 2017 after leaving corporate life behind was I went and bought a 5-unit property, which was, for those who don't know, 5 units and above qualifies it as a commercial real estate property, whereas if it's 4 units or less, it's considered to be residential. And the significance of that difference, it may seem minuscule, but the significance is the financing is very different when you're pursuing residential financing for a 1 to 4 unit, as opposed to a 5 or greater unit. And basically, the reason that I pursued the 5 unit was because when you are seeking financing for a commercial real estate property, they are, as a lender, they are assessing the property as a business. And so they are looking primarily to the business and determining what are, based upon historicals and based upon projections, what is this property, what is this business going to generate in terms of revenue, and do we feel comfortable based upon that lending whatever the amount is. And then they look at you as a buyer secondarily, and they want to see, have you been involved in a bankruptcy? Maybe they look at your credit score, but they're not looking at your personal finances. They're not asking for, a W-2. I don't even think they asked for a W-2 when I bought that 5-unit. Quite the contrary of buying residential, where the first thing they're going to ask you for is 2 years of your tax returns and then your last 2 pay stubs. And when you tell them you don't have a pay stub or you don't have a W-2, that does not compute for them, and they can't wrap their head around that, and they try and put a peg into a square, and it doesn't fit. So one of the aha moments for me was really coming to the appreciation that it's much easier for you to go get a large commercial real estate property than it is even to either refinance your personal residence or to go buy a single family rental property as an investment, simply based upon how they are evaluating you and assessing you from a lending standpoint. So I got that 5-unit, which was really a kind of a proof of concept. Do I really want to be doing this real estate thing? Do I want to be a landlord? Do I want to be managing a property? Do I want to be renovating units, dealing with evictions to the extent that that's a reality of being a landlord? So I did that. So I ended up selling that property literally 2 weeks into COVID. So I sold that at the very end of March of 2020. And I made the decision that, okay, no more of the small stuff. I'm going to focus all of my efforts on not only investing passively in these large scale multifamily properties, but now being a sponsor and a partner on these transactions. And so fast forward to summer of 21, I was awarded my first large scale deal. And so that was kind of the breakthrough after plugging away for the better part of 2 years from the time of submitting my first offer on a large scale multifamily to actually getting awarded that first one. It was just over 2 years, including kind of a dormant period as a result of COVID, and obviously lots of things were not happening normally, and inventory and deal flow wasn't happening normally. So in any event, I'm not an example of an overnight success. It took 2 years of perseverance and resilience and pursuit, and acclimating myself outside of my comfort zone of 20 years in corporate life, transitioning to being a real estate investor and entrepreneur. Very different world, and you definitely, I had to kind of get outside of my comfort zone and develop some muscles that I didn't need to leverage in my prior life, and kind of retool and reapply the skill sets that I had from prior lives to what I was now focused on, which was large scale multifamily acquisition and ownership. So was awarded that first deal, a 244 unit deal here in Atlanta.
How much was that?
I'm sorry?
How much was that? What size?
Yeah, so that was just shy of 30 million.
Okay.
So we acquired that. We closed on that property in November of 2021. And the same week that we closed on that property, I was awarded a second deal, also in Atlanta, also south of the airport, Clayton County, for those who are familiar with the area. And that is a 200 unit property, and we acquired that for just over 40 million. So in the space of 3 months, I did 2 transactions totaling approximately 70 million in value. And for the first deal, we raised $8.25 million in equity from our network, friends, family, colleagues, and what have you. And on the most recent deal, which we closed in February of this year, 2022, we raised approximately 13 million in equity for that deal.
And what is your role in these deals? Because clearly you have a team. What are the roles that are necessary for making these deals happen successfully? And what is your place on the team?
Yeah, so for me, my position within my team is I'm the boots on the ground. So on each of these deals, I have 3 or 4 partners, none of whom are based in Georgia or Atlanta. So I have partners in Texas, Houston and Dallas, and a partner in Los Angeles, but I'm running point. So from the time of underwriting, determining whether or not we can make an offer that's going to be competitive, financially based upon the numbers and our pro forma projections. I'm underwriting the transaction. I'm getting all of the necessary inputs to inform the underwriting. I'm touring the property. I'm having the direct one-to-one conversations with the selling broker. I'm I'm the lead on all of that activity, and then surrounding myself with the team that I need to take to be successful in winning the deal and getting it under contract. At the end of the day, that's what it's all about. And then ultimately, after it's under contract, demonstrating and effectively closing on it in a timely manner. So when you're breaking into this world, which is part of the transition, it doesn't really matter what your background is or what you've done. Selling brokers, their responsibility to their clients, the sellers, is to ensure that they deliver a buyer who is credible and has the ability to close. At the end of the day, if the deal does not close, that reflects poorly on them. And so they never want to put in front of a seller, their client, they never want to put in front of them a buyer who has a questionable track record or doesn't have experience. And so when you're coming into this space as a quote unquote newbie, what you've got to do is associate yourself with experience. And so these deals, 30 million, 40 million, when you're acquiring these deals, this is not an individual acquiring these. This is a team that you are assembling, and then everyone has a different role to play. So capital needs to be raised. I mentioned 8.25 million on the first deal, 13 million on the other. Each of us has a role to play with respect to going out to our networks and raising capital, generating interest in the opportunity, educating about the opportunity. And then eventually, we come together, we do a webinar where we kind of present the property, we answer Q&A, and then ultimately we open up the opportunity for people to invest in. The team beyond kind of my immediate partners includes, a lawyer who's going to handle the transactional piece of the deal. So I'm a lawyer, one of my partners is a lawyer, but it would be malpractice for either of us to try and do the legal work for a deal that we are offering to, our network. And so we have a lawyer who handles the transactional piece, and also the same lawyer happens to handle the securities piece. So when we are presenting these opportunities to our network, that is a securities offering, and there are certain rules that we need to follow and adhere to. And obviously we don't want to run afoul of any of that. So we have that lawyer. So I consider the lawyer and the law firm part of the team, handling the role and responsibilities that they need to handle. Then we have insurance brokers, ensuring that we're getting the best possible insurance for the property once we take over. We have tax consultants who we are seeking out for advice with respect to what is the likely taxes going to be when this property is reassessed based upon the purchase price. And so all of these team players have a critical role to play. Some are more of a temporary role, and then others are more of a longer term role. And then once we get to the closing table and we close, that's when the real work begins, because now the property has to be managed, a business plan needs to be implemented and executed on. We don't manage these ourselves. We turn these over to professional third-party property managers. But nonetheless, it's our responsibility to asset manage the deal and ensure that our third-party property manager is executing on our business plan so that we're able to ultimately deliver the returns that we've projected and forecast to our investors.
Sure. We spoke a little bit earlier about generational wealth and involving, children in the process. Could you speak on your thoughts on real estate and its relation to generational wealth and how you are using that in your family?
Yeah, so there's a quote out there that says 90% of the millionaires, and this is in a US context, but 90% of the millionaires, either they made their money in real estate, or their money, if not made in real estate, is now sitting in real estate, commercial real estate of all types. So there's a lot of truth. There's a lot of truth in that. And as far as generational wealth, I'm constantly telling people that it doesn't really matter how highly compensated you are as an employee, you cannot pass on to your heirs a high compensation. So if you are blessed to be highly compensated, my advice is you should be thinking about how can you diversify your income streams. And so I'm not saying quit your job, but if you are in a position, and let's assume it's a demanding position where you don't have the opportunity to be as active an investor as I am today or others are, you still have a responsibility for making sound investments that are going to generate cash flow that reduces your 100% or your exclusive reliance upon a paycheck, because that paycheck can end tomorrow. You could go into work and they could say, Tony, thanks for your years of service. We no longer have a need for your role, or we no longer have a need for you. And, if you're blessed, maybe you get a severance package or what have you. But at the end of the day, your reality from a financial cash flow changes overnight. And if that were to happen to you, you want to be in a position where you have income coming in from other sources potentially. And so the time to do that is not when you have that conversation. You need to be doing that today and positioning yourself so that if that were to happen, you would not be in a position of going from high income to no income. And so, as far as generational wealth is concerned, whether you're investing passively in the types of opportunities that I have and share with my community, or you've decided that you want to be more actively involved and you want to be a sponsor or a partner on these deals, whether it's passive or active, both of those are going to produce cash flow and returns to you that and benefits to you, like the tax advantages associated with real estate investing. Whether you like it or not, this country likes people who own property and rewards people who own property. And whether it's your personal residence and the tax deductions and that you're able to take as a result of that, or whether it's your non-personal residence, real estate is a favored asset class by the US government. And I know that because if you read the tax code, you'll see that there are all kinds of benefits that are attributed to real estate ownership. And you would be wise to take advantage of that. Yeah. So in terms of generational wealth, you need to be investing in appreciating assets, especially in an inflationary environment like we are now, where I think the last estimate I heard was that inflation is something like 8.5%. And there are economists saying that that's the official government figure, but real inflation is probably closer to 15 or 16%, so twice the official amount. So that means if you have $100,000 sitting in the bank this year, next year it's going to be worth, anywhere between 92,000 and change and 85,000. So you're actively losing money as it sits there in the bank. And so the best thing that you can do to offset that is to be investing in assets that are appreciating in value and appreciating at a rate that outpaces inflation. And so when I talk about year over year rent growth of 25% in the case of Tampa and 18 to low 20s in Atlanta and other amounts in other, double digit on average across the country, that is at least outpacing the stated official inflation rate. So, and that's not mentioning the tax benefits that go along with it, the cash flow that comes from it and all those things. So the best thing that you can be doing is investing in assets that appreciate in value. And when you're investing in large scale multifamily, you're investing in a business where the value of it is unlike personal residence or single family homes, where the value is largely determined based upon what is the house down the street selling for? What did the house across the street sell for? And the appraisal of your property is going to be heavily influenced by the answer to those two questions. Commercial real estate doesn't work like that. Commercial real estate is a business, and so it is evaluated based upon the revenue that the business is generating. And so you can have two identical properties side by side with widely varying values based upon the revenue that each property or each community is generating. And so when you come in as a multifamily owner operator, you have the ability to do what they call force appreciation. And so basically that just means that you are doing things from an operational standpoint, you are doing things that are going to force the value to appreciate. You're not waiting for a sale across town or a sale across the street to see what they made. You have the ability to force appreciation, improve net operating income, which is the biggest factor that we look at in this space, which is what is the net operating income, and anything that I can do to increase that net operating income, whether or not it's bringing more revenue or tighten up expenses and reduce expenses. Anything that you're able to do there can lead to substantial jumps in the value of properties. And again, you're not sitting around waiting for that to happen for years. You are proactively forcing that appreciation.
What are the most common things you can do to force the appreciation of a property? Some things that I guess come to mind are whether it's like installing like washing machines or improving some of the features or adding features that are there. What are some other?
Yeah, that's certainly one thing. So if you have a property where there are washer and dryer connections, you can, as an owner, decide that, you know what, we're going to supply washers and dryers to those units, to those residents. And either you can, let's say you charge $50 for a washer dryer set each month. A tenant may, either they have their own, in which case they don't need it, or they're renting from some third party and maybe they're paying $50, $60, $65. As an owner, you can step in and say, look, we'll provide it, and we're going to do that. We're going to do that in a comprehensive way across the property. And that is additional revenue, now new income that wasn't being achieved at that property before. And so there's obviously an upfront cost and expense associated with the acquisition of the washer dryer set, if that's the way you go, because you can buy them outright, or you can rent them and then in turn rent them on to the residents, and hopefully there's a differential, otherwise it wouldn't make sense for you to do that. But there's a number of ways you can approach it. So that's one example of how you can increase income. And again, that's going to trickle down to that bottom NOI, that net operating income. Other things that you can do is you can add valet trash. May not be something that's present at the property. So you may have residents that are currently bagging up their trash and taking it to a dumpster. And maybe you introduce valet trash and you say, we're introducing this service that we think is going to be appreciated in the community. And obviously there's a cost associated with that. And so, most residents are going to embrace that and say, you mean I don't have to walk to the dumpster with my trash and I just put it here outside my door and someone handles that? They're willing to pay for that type of amenity and that type of service. And so any of these things that you do, whether it's covered parking or reserved parking spaces, maybe you pay, to get a reserved parking space. There are some residents that are willing to pay for that so that they're not walking from the other side of the community to where their actual entrance is, especially in inclement weather. It's raining, you've got your groceries, you want to be able to park close to your door. Maybe you'll pay $15, $25 a month for a dedicated space that is yours. And so these are some of the things that you can do that are going to, improve, hopefully, the amenities and services of the residents, and again, contribute to increasing that bottom line net operating income.
If you could look back and ask or tell your younger self, like knowing everything that you know now, going through the gauntlet of being a real estate investor and entrepreneur, what would you tell younger Clive?
Yeah, I would tell younger Clive that you don't have to work for 20 years in corporate life before you pivot and make a transition to do something that you've been curious about wanting to do, but haven't done sooner. And so, I don't have any regrets about my 20-year corporate career. I think some of the opportunities I've been afforded are a result of the experience and the background that I have. And so, it all plays a role. It all serves a purpose.
Mm-hmm.
But I would just say start younger and be, more courageous and be willing to take more risk and get outside that comfort zone that I referenced a number of times. Get outside that comfort zone sooner, and that would be it. Bottom line, it would be willing to take risk and take it sooner.
Yeah. So what would you say would be the blueprint for someone who is, maybe on the younger side, and even if they're not, even if they're middle aged and they're just like, you know what, I'm ready to get started now because there's no wrong time to get started in real estate. What would you say is the blueprint, the formula for success in multifamily specifically?
Yeah, so it's first and foremost is getting yourself educated on the space that you want to be in. So when I left corporate life, I had, before 2017 or even late 2016, I had not listened to a podcast start to finish. That reality changed to the point in 2017, I was listening to 3 to 4 podcasts a day, strictly on or related to multifamily investment. And so I probably have, I would say, 3 dozen podcasts that are in rotation that I listen to today. And so that was part of my education. Attending conferences, dedicated multifamily conferences where that's the subject, that's what everything is focused on, which gives you an opportunity to get education from the stage or from the booth or whatever, and then networking with people who are immersed in the multifamily space. And so that was part of my education. So I would emphasize making the investment in yourself as a young person. I would advise you to seek out mentorship. I certainly did, and that proved to be, integral in my success. The partners that I have today that I mentioned earlier, the primary partners, all of them are in the same mentorship program that I bought into. And so I would tell you that this isn't rocket science. The information is out there, it's available, it can be found. However, I'm all about efficiency. I want to figure out, how do I get from point A to point B in the least amount of time? So what's the straightest line between those 2 locations? It might take you 3 years of kind of figuring it out on your own and trial and error. If you associate yourself with a mentor, the real value of a mentor is they should be able to compress those timelines. So if it would take 3 years of you kind of fumbling around through trial and error, they should be able to compress that 3-year timeline down to 1 year. And that's the beauty of a mentor. And if a mentor is not doing that for you, then you're wasting your money, or you're wasting your time, or you're wasting both. And so I currently mentor a handful of individuals, some informally, some more formally. One of them is a 28-year-old individual who just closed on a 48-unit property. He now has 96 units, if I'm not mistaken. And he has his own property management company that manages all of these units. And I'm mentoring him and advising him that, your next property, your next acquisition needs to be 100 units or more. And I'm trying to disabuse him of kind of limiting beliefs about what he's capable of doing. And a lot of times we make the mistake of limiting ourselves in what we pursue because we're we're thinking that we have to pursue it as a sole or lone operator. And what I mentioned to you earlier is the importance of surrounding yourself with a team and figuring out, what do I need to accomplish my goal that's in front of me, and whatever deficiencies I have, that those deficiencies can be filled by me associating with other people who have experience or capital or know-how or whatever the case may be, in order for me to accomplish what it is that I want to do. So to that young person, educate yourself. There's a ton of free education, but don't be dismissive of paid education. You know, those of us who have been blessed to attend universities or colleges, we don't question, you know, paying tuition, room and board to go get a degree at the end of it, on the assumption or wish or hope that that's going to lead to some job. But when it comes to being an entrepreneur, you're not necessarily paying an academic institution, but you still need to be educated. And so that is an investment that you make. That investment, there's going to be a return on that investment. And so you don't want to be cheap about educating yourself and then spending 2 additional years or 2 longer years than you might have had to spend if you went ahead and made the investment in yourself and your education up front. And so education is key.
And I've said it better myself. Wise words and some great insight, Clive. Thank you so much for taking the time to, explain a lot about multifamily and sharing your experience. If people want to reach out to you or join any groups that you have or forums that you have going on, like where can they do so?
Absolutely. So I'm active on social media. I'm active on LinkedIn, so you can find me there. I'm active on Facebook. And I also host a group on Facebook, the African American Multifamily Investor Network. So if you put that in, the group will pop up. Right now, there's about 1,200 of us in that group, and it's strictly focused on multifamily. We don't talk about wholesaling. We don't talk about flipping. We talk about multifamily, and it's a community that really I'm proud of. And my objective is to kind of curate a space where the members in that group can serve as a resource to one another, can serve as inspiration to one another. We are woefully, and by we, I'm talking about Black people are woefully underrepresented in commercial real estate. I think it's less than 2%. Of professional positions within the commercial real estate space are occupied by Black folks. So I wanted to curate a space where people would see examples and models of people who look like them or come from communities similar to where they come from, being successful at all levels in many different roles. The beauty of commercial real estate is there's no one way to access it or enter it. There are many different lanes that you can occupy, many different roles that you can occupy. And so we have everyone from folks who are looking to invest in their first real estate deal or duplex or investment, to people who are closing on 1,200, 1,300 units in one transaction, and everything in between. And so it's a community and a resource. So I can definitely be found in that group. I just launched my Instagram earlier this week, because I have a website that will be going live. So parkroyalcapital.com coming soon. And that's my handle on my Instagram also. And, folks can reach out to me. I love talking about real estate. Yeah.
Awesome. Well, thanks again, Clive. You have a great rest of the day and best of luck with all your future endeavors.
All right. Same to you. Appreciate it. Thanks for having me on.
No problem. Take care.